James closed on his house last year at a rate of 6.8%. He had spent months preparing, saving the down payment, cleaning up his credit, researching neighborhoods. He did everything right. And when he finally sat across from the loan officer and signed the stack of documents, he asked one question that had been bothering him for weeks. Why 6.8? What determines that number? The loan officer gave him the kind of answer that sounds informative until you realize it contains no actual information. Rates are where they are right now. The market sets them. It's just how it works. James nodded, he signed, he drove home in a car with a 7.2% loan rate, parked it in front of a house with a 6.8% mortgage, and opened his 401k statement to discover his bond fund had quietly lost 11% over the previous 18 months without anyone explaining why. 3 different financial products, 3 rates and returns he accepted without understanding where any of them came from. What he did not know, what almost nobody tells you, is that all 3 connect to the same source, a single market most people have never thought about once in their lives, despite the fact that it sets the price of almost every financial transaction they will ever make. That market is the bond market, and this video is the explanation James never got. Strip away every piece of financial terminology, and a bond is the simplest financial instrument that exists. It is a loan with a document attached. Someone needs money, a government running a deficit, a corporation funding expansion, a city building infrastructure. Rather than borrowing from a single bank, they borrow from thousands of investors simultaneously by issuing bonds. You hand over $1,000. In exchange, they promise 2 things: a fixed annual interest payment for a specified number of years, and the return of your original $1,000 on a specific future date. The annual payment is called the coupon. The date you get your money back is called maturity. Everything else about bonds is variation on those 2 elements. When the U.S. government needs to fund the gap between what it collects in taxes and what it spends, it issues treasury bonds. When Apple needs capital for a new project and wants cheaper borrowing than a bank loan, it issues corporate bonds. When a company with shakier finances needs to borrow, it issues what the industry diplomatically calls high-yield bonds, a rebranding of the older, more honest term, junk bonds. The concept is ancient and genuinely simple. The part that trips people up is what happens to bonds after they are issued. Here is the single most important idea in this video. Once you understand it, you will see it operating everywhere in the financial news you have been half following for years. When prevailing interest rates rise, the value of existing bonds falls. When rates fall, existing bond values rise. They move in opposite directions, always, without exception. The reason becomes obvious with a simple example. You buy a $1,000 bond paying 2% annually, $20 per year. A year later, new bonds being issued by the same borrower now pay 5%, $50 per year on the same $1,000 investment. You want to sell your bond. Who buys it? Nobody at full price. Why would they pay $1,000 for something paying $20 annually when they can buy a new bond paying $50? The only way you find a buyer is by dropping your price, dropping it far enough that your fixed $20 payment represents approximately 5% of whatever you sell it for. That math works out to selling your $1,000 bond for somewhere around $400. You bought the safest investment available. Rates moved against you. You lost 40% of your principal, not because the borrower defaulted, but purely because of interest rate movement. The borrower will still pay every cent they promised. You just cannot afford to wait for them. This is the rule. Tattoo it somewhere useful. Every financial disaster covered in the next section is this rule operating at larger and larger scales. Here is the connection most people miss. The bond market does not just affect bond investors, it prices everything. When a bank writes James a 30-year mortgage, it faces a basic question. Why would it lend money to a private citizen for 3 decades when it could instead lend money to the United States government, the safest borrower in the world, and earn a guaranteed return with zero risk of default? The answer is it would not, unless James pays more. So the bank looks at the current yield on the 10-year U.S. Treasury note and adds a premium for the privilege of James being a regular human being who could lose his job, get sick, or experience any number of complications that the U.S. government is unlikely to face. That premium runs roughly 2 percentage points in normal conditions. 10-year Treasury at 4.5% means mortgages around 6.5%. 10-year Treasury at 1%, which is where it sat in early 2021, means mortgages approaching 2.7%. The government bond market set those rates. The bank was simply doing arithmetic. This is not specific to mortgages. Car loans are priced off the same underlying rates. Business loans, student loan refinancing, the interest rate your city pays to fund infrastructure, all of it flows from the same source. When bond market yields rise, every borrower in the country faces higher costs simultaneously, as if some invisible landlord decided to raise the rent on all of borrowed money at once. The bond market is not abstract. It is the engine running in the background of every financial decision you make. For decades, the standard retirement advice was straightforward. Own stocks for growth, own bonds for stability. When stocks fall, bonds protect you. This combination, typically described as 60% stocks and 40% bonds, was considered a foundational principle of responsible investing. Then 2022 arrived, and that principle failed in a way it had not failed in nearly half a century. The Federal Reserve, responding to inflation that had reached levels not seen since the early 1980s, raised interest rates from near zero to over 4% in approximately 9 months. Apply the rule. Rates rising sharply means existing bond prices falling sharply. The broadest U.S. bond index delivered its worst year on record, losing around 13%. Long-term Treasury bonds, the very safest assets available, lost nearly 40% of their value. The 60/40 portfolio, designed specifically to protect retirees from stock market volatility, lost roughly 17% in a single year because bonds fell alongside stocks rather than cushioning the decline. People who had done everything correctly by conventional wisdom, diversified their savings, allocated appropriately for their age, kept the conservative portion of their portfolio in supposedly safe government debt, discovered that SAFE had a footnote nobody had read aloud to them. The footnote is called duration. Duration measures how sensitive a bond or bond fund is to interest rate changes. Specifically, it tells you approximately how much the value drops for every 1 point rise in rates. A fund with a duration of 6 loses roughly 6% when rates rise 1 point. A long-term Treasury fund with a duration of 17 loses roughly 17% per point, and in 2022, rates rose more than 4 points. The retirees who were hurt most in 2022 were not reckless. They were invested in government bonds and had no idea how much interest rate risk they were carrying. They owned duration they had never been told to measure. The most vivid way to understand what this rule does at scale is to watch what happened to specific institutions and governments when rates moved sharply. Silicon Valley Bank was among the 16 largest banks in the United States. During the technology boom, it accumulated deposits rapidly and invested more than $90 billion of those deposits in long-term government bonds, genuinely safe assets as advertised. Then rates rose sharply, and those bonds lost enormous value on paper. When the bank needed to sell part of its portfolio and disclosed a loss of nearly $2 billion, depositors panicked and withdrew funds faster than any bank can absorb. SVB went from appearing healthy to being seized by regulators in approximately 48 hours. A century and a half of banking history ended by the same used car analogy that opened this explanation. Perfectly fine, impossible to sell at the original price. On a national scale, the United Kingdom's government in late 2022 announced a package of large, unfunded tax cuts. The bond market's reaction was immediate and severe. Investors sold UK government bonds so aggressively that yields spiked dramatically within days. That spike cascaded into the pension fund industry, where certain investment strategies depended on yields remaining stable. Pension funds were forced to sell bonds to raise cash, which forced more selling. The Bank of England had to intervene to prevent what officials later acknowledged could have been a systemic collapse of the UK pension system. The Prime Minister who had announced the policy resigned 45 days after taking office. The bond market had, in effect, overruled the leader of a major economy. Understanding the bond market is not about becoming a bond trader. Most people should not trade bonds. It is about recognizing the mechanism that prices your financial life so you can make informed decisions within it. Several practical implications follow directly from what this video has covered. The cash sitting in a standard bank savings account earning near zero is not neutral. It is giving up the 3 to 4% available in treasury bills and high-yield savings accounts while taking on no additional risk. Your bank has no incentive to mention this. You can simply move the money. If you own a bond fund in your retirement account, look up its duration. It is listed in the fund documentation. That number tells you your actual exposure to interest rate changes. A duration of 2 means modest sensitivity. A duration of 15 means you're making a meaningful bet on where rates move, whether you intended to or not. If you are following economic news, track the 10-year Treasury yield as a single indicator of where borrowing costs are heading. When it rises, mortgages, car loans, and business financing all follow within weeks. When it falls sharply, it typically means enough investors are nervous about the economy to seek safety, which is itself a signal worth noting. James still lives in his house at 6.8%. He will probably refinance if rates fall meaningfully. He understands now that whether that happens depends on the 10-year Treasury yield, which depends on inflation expectations, government borrowing, foreign demand for U.S. debt, and Federal Reserve policy, none of which he controls, all of which he can now track with basic literacy. The number on his mortgage was not arbitrary. It was not chosen by his bank. It was produced by a market processing the collective judgment of investors about risk, inflation, and time across trillions of dollars of transactions every day. You have been participating in that market your entire adult life, through every loan you have taken, every retirement account you have funded, every savings account you have left sitting at the wrong rate. The only thing that was missing was the explanation. Now you have it.